I mean, inflation is going down, so that's comforting. It's going in the right direction. And also over the last 3-4 months, inflation has been in line with our forecast, which has not been honestly the case for probably a period of 2 years. So it means, to answer your question, that I think we can now use the forecast as sort of benchmark. And would, if inflation develops as foreseen in our projection, we go back to 2% in 25 and we don't have to hike again. If inflation would be higher than our forecast, more than marginally, then I think we have to do more.
Yeah. What is your perception of how the numbers have been coming in recently, though? Because it seems to me actually they're almost undershooting what the ECB has penciled in for the inflation trajectory.
Yeah, I try to look at momentum more than a year-on-year, because year-on-year, you have base effects, and because of, for instance, the train tickets going up and down in Germany, it's difficult to read the momentum.
Yeah.
But indeed, again, coming back to what I was saying, we didn't have bad surprises and maybe marginally good surprises on inflation recently. If it keeps developing in this direction, then we are done. But we've been surprised in the past, and also in the U.S. At some point, people were of the opinion, okay, now it should be okay. Some central banks posed to arrive at the conclusion that they had to do more. So I'm pretty open on that front. I mean, let's look at the inflation development.
Would a persistent shock in the price of oil bring about another extra hike from the ECB?
It could. I mean, honestly, it is one of the factors that could push inflation higher. And again, I mean, inflation would be higher in a way that we would not meet our target in 25. Then I think we would have to do more.
But in the past, the ECB has told us that they'd be willing to look through these more volatile measures. It was only a couple of years ago that when we saw a similar supply shock, the ECB told us that this type of inflation was transitory. Has the reaction function changed now?
I think it's more than a reaction function. I think it's just our reading of the impact of a succession of shocks has changed. I mean, honestly, the developments over the last 20, 30 years in observed inflation, but also in the modeling of inflation, we had arrived at the conclusion that, sustained inflation was becoming close to impossible. So we were willing to look through a lot of shocks just because we hadn't seen inflation above 2% for a long period of time. We've seen that now. So I think it's much more than the reaction function. It's just the way we understand that inflation can be more persistent than we thought, and then we had from our models.
Yeah, the paradigm has definitely shifted somewhat. I'm getting that from my conversations with central bankers. Just taking a step back, and you and I were speaking a bit before this interview, if you had told me that the ECB were going to hike more than 400 basis points and we wouldn't see major systemic risk flare up in the system, I think few people would have believed that they would be able to do that. But then I guess the alternative view is it's because we still haven't felt the full force of the monetary tightening that the ECB have delivered. We know that monetary tightening works with the monetary policy lag. Yeah. So how do you think about what's to come in terms of the impact this monetary tightening is going to have on the broader economy in the coming years?
Well, I think we have to distinguish the lags of the impact of monetary policy on inflation and on financial markets and for instance, banks. So the tightening has an impact on credit developments, and the impact is actually maybe stronger than we thought. So that channel is working, and maybe even working more than we had in mind. The translation of that tighter financial markets and bank credit conditions into inflation is going to take some more time. But again, trend is going in the right direction. I think we now have relatively good indications that we did the job after the 2008 crisis. We hiked, buffers in capital and liquidity in Europe, and we have a stronger banking system. I think this is something we can take not as a given forever that nothing bad can happen, but also the fact that those institutions are relatively independent. They were able to despite banks not being happy from time to time, for a long period of time put some pressure in the system.
Yeah. So in general, the system, I guess, more resilient, more robust. There is a lot of talk about, as well, the ECB's desire to decrease the size of the balance sheet. Could we expect an announcement in October on the PEPP reinvestment roll-off?
I don't want to say anything about a specific timing, but I think, I've been one of the governors saying we need to reopen the discussion on PEPP. I'm checking every day that you still have people, getting COVID, but the numbers are going down.
Yeah, but let me just ask you, when you talk about PEPP reinvestment, of course, the key factor why PEPP has existed for so long, reinvestments have existed, is the flexibility notion, and that is supported for periphery spreads. In an environment where we start seeing periphery spreads widen, we're watching BTP bonds very closely, would that disincentivize the ECB from making a decision on the balance sheet reduction?
We're going to have to stop with PEPP reinvestment at some point. So my take is that, we've tightened monetary policy conditions, we have hiked a lot. I think we have to have a new discussion on when we start reinvesting, or at least partially for PEPP. We have TPI, and we are not there to be on a structural basis buying government debt for buying government debt. We did it because our inflation was too low. But we have TPI, and we had TPI in mind, knowing that PEPP would at some point have to be...
Are we close to levels where TPI could be triggered?
Well, there is a condition for triggering TPI, which is it has to be unwarranted. So we'll see if something happens, whether it is or not unwarranted. And sometimes you're in a gray zone, and then it's not so easy. But
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.